Hey guys, what's up, how's it going? Welcome back for another video on the channel. In today's video, we're going to be doing a portfolio update of my Wealthsimple trade account. We'll go over my accounts, we'll go over my net worth, everything like that. You know, if you guys watch this channel, you guys kind of know how these videos go. I'm also going to talk about finances and stuff like that because I haven't really talked about personal finances and budgeting and stuff like that for a little bit on this channel. So I want to kind of get back into that. Now it's a good time to do that. So this video is going to be a little bit longer than some of the other videos I've done in the past, even though most of my videos tend to be a little bit alongside anyways. So hang in there guys, we got lots to cover. And we're going to talk about a brand new account on Wealthsimple Trade, and I'm going to discuss some things that I've been kind of thinking about and going over the past little while. So first of all, let's do a portfolio update. We'll kind of do that stuff first and then we'll get into things one by one here. So as you guys can see, here's my account. This is just going to be my own personal account. I'll give you guys a bird's eye view of all of our accounts as we go through the video, but we will just cover my own personal Wealthsimple trade accounts first, just to get things started. So you have $211,000, $500, $211,500. Pretty big jump in the market recently, as we'll talk about here. That's about 70% gain all time. And Wealthsimple has these cool things where you can click on your account. I just noticed this. You can click on the accounts and you can see some cool information. So if you guys are trying to track like your deposits, your gains, you can also do it like from your TFSAs and your RSPs and stuff. So definitely check this out. Some cool little things here you can go through. You can look at some different stats here. So some pretty cool things there. You can also see like your stocks you sold, which is pretty cool here. I don't know if you guys can see this at the bottom of the screen, but we have a plus $5,000 gain. These are all the stocks I've sold in the past and whatnot. So it's kind of a cool little thing there. You can see the dividends all time, $20,000 in dividends, pretty cool. Simple return rate, right? 70% time weighted. I don't know if these are like 100% accurate or not, so just kind of keep that in mind. But some pretty cool things there. You guys can click on that. Anyways, 1 month return for the portfolio is up 3.25%, so a bit of a jump over the past month. Nice little gain there. It's about $6,000 to $7,000. 3 month return is up 11%, $21,000. Again, I like to just always kind of say this since the portfolio has really grown since I first started doing these videos. Even small percentage jumps mean a lot of money as you build that portfolio. So if you can build it as quickly as possible, like we did, and really just work on it really hard to get that compounding going, as those little percentage points start to grow, it really starts to add up. And you know, remember, you know, like at the beginning of the year, we had that bit of a dip in the market, like 6 month return, we see this big dip in the market around April. So that's, you know, when everybody kind of, you see the headlines, you see the kind of scarcity, you see people kind of freaking out. Like I always tell you guys, just keep going at it. You know, you never know what could happen. Maybe markets drop, maybe they dip, maybe they don't, but most likely they kind of just do their thing. And if they go up in time, and when they go up in time, you get the benefit. So last 6 months, we saw a nice little gain here. So the portfolio has grown, still reaching all-time highs despite even dipping here. And throughout this dip, we did buy a lot. We bought a lot actually in the markets this year. We bought, I think, more money into the market this year than we ever have, and we'll show you guys. I'll talk about this when you go through our deposits and stuff like that. Year to date, our portfolio is up 9%, almost 10% year to date, so that's about $18,000. And again, this is just mine. We'll go over our entire portfolios later on, so there is still more than just this. 1 year return is about 17%. That's about $31,000. Again, mostly in TFSA, RSP, and first home savings account, but the bulk of it in the TFSA. In fact, in today's video, actually, I'll go over those individual accounts because I haven't covered them for quite a while here. But again, all-time return portfolio has been doing good. Nice little jump up here. You can see over the last little while. So we're going to go down here. I'm going to go through all of our accounts one by one here just to give you guys an idea of what we have here. So the checking account, I've been using this here and there. It's got a couple $100. I get my payroll in there, get a little bit of interest. I kind of use it alongside my traditional bank account. I haven't moved completely over to Wealthsimple, but as time goes on, I might do it. I just like to have 2 accounts for now, but if you guys want, check out the checking account. It's really handy, a lot of good features, definitely a good account, and you can move money like easily between the accounts instantly with it, which is super cool. So definitely like that. TFSA is the biggest account here. Let's just pop into it really quickly here. We can go all-time return, and you guys can see here, this is how much the TFSA. Keep in mind though that I have had a previous TFSA on here, that the gains are not showing on this account, so it always confuses everybody. So there are some previous gains from previous accounts we had in Wealthsimple that we closed that you guys can't see, but it's reflected in this all-time gain up here. So just kind of keep that in mind there. But that's the TFSA, about $178,000. I'm hoping, you know, maybe by the end of the year, beginning of next year with our contribution, we can get that up to $200,000. that'd be super cool. Be pretty excited for that, but that might happen, it might not, depends on things. We're definitely going to need some help in the markets there, but maybe towards the beginning of next year with the contribution we can get that. Our first home savings account for mine is maxed out this year. I maxed it out at the start of the year, more or less, and all time it is up 14.52%. So about $2,000, $322. Again, we're trying to build this up as much as possible before we do go and buy a house. Me and my fiance will put both of our first home savings accounts together, and then we'll get whatever gain plus the tax-free money for a down payment. So this is a focus. This has actually been one of our bigger focuses, is to get these accounts maxed out and then claim them on our taxes, and then take that tax gain and put it back in the accounts, and et cetera, and kind of just delay buying a house to benefit from it from some degree. And the first home savings account, if I remember correctly, is set up to be about, I think it's a 60-40 split. I can show you guys later, but it's mostly growth oriented with VFB and VDY. In case you guys don't notice, we have a new family member here, new kitty. So if you see her jumping around there, she's going to probably be in the videos causing trouble and whatnot. So if you see her jumping around and whatever, she's quite a ball of energy here. She's a great cat. She's super lovely, but she likes to jump around and play around and wake you up in the middle of the night. So I'm just going to put her down here, and I'm sure we'll see her back throughout the video there. But that's the first home savings account. The RSP is the other registered account. The main focus for the RSP, because we're so far away from retirement, is just going to be building up for a down payment for a house, more than likely. So again, the longer we can delay buying a house, for us, the plan is over the next 1 to 3 years, but ideally probably delaying it as much as possible. Even if we have to rent for like a house for like a year or two because we need the space, because we might at some point, that still allows us to kind of save a little bit of money in short term, kind of build up the accounts, shop around a little bit, and have our investments grow. But again, we'll kind of working that thing out. But the RSP for me will just be to use for a down payment most likely, because we're so far away from retirement, and then we'll just pay it back as time goes on. Now, the big thing we're going to talk about in today's video is going to be the new account I opened. Now, I've done some research, I've done some thinking about this, and we have a non-registered margin account. Now, I did a write-up. I'm going to bring this up here in just a second so you guys can see, but I did a cool write-up on Blossom. I'll bring this up in just a second. So if you guys don't know, I use Blossom Social. Can't speak this morning. Blossom Social is a cool app, and they do have a desktop feature where you guys can check out my stocks, you can check out my holdings, but it's also a cool platform because you can ask people for tips and information, stuff like that. So I did a post recently where I basically posted to get some ideas on margin investing, because I've been researching the margin. As you guys know, Wealthsimple has been pushing their margin accounts like crazy. So I wanted to kind of do a video to talk about this, but also like kind of showcase to you guys like the risks with this kind of stuff, because I know a lot of people are going to see this and they allow you to link your TFSA, and I could see a lot of people getting into trouble with this. So I did an outline on Blossom Social where I basically outlined a strategy that I looked up and researched, and I put together a cool step-by-step plan on a smart way to use margin investing. Now, I do apologize, some of the formatting on here didn't go out the way I wanted to do, so like it's a little bit messy, but it is readable, unfortunately, but I do apologize for that. But it's a nice step-by-step, very detailed plan on how you can use a margin investing in a conservative way to grow your portfolios. And I was thinking about doing something like this myself, but honestly, after reviewing it and getting some good feedback from thank you for everybody who commented on this post. You guys can check it out. It's on my portfolio, on my profile, if you guys want to look into it and research it yourself. But I think one of the big things for me is I basically used ChatGPT to kind of build the plan itself, which was super helpful, super cool. Definitely check out ChatGPT for like setting up scenarios, building a portfolio, allocations, reviewing things, getting feedback. It's a super cool tool. That's kind of basically how I got a lot of these ideas to build it. But just keep in mind that it sometimes can screw up numbers, percentages, tickers, different things like that. So just keep that in mind. And you have to be very specific with things. But basically what happened is we built this cool way to invest with margin. Now, again, I kind of reviewed this, I looked up, and one of the big things with doing this kind of style is that the only thing that would basically break things would be like a Great Depression. And even though something like that probably wouldn't happen, let's be honest, just the thought of it happening and losing all your money is something that, I thought about it, I was thinking about the other day, and it might be something we might not want to do, even though I would say that 99% of the time that's not going to happen. Like if we outlined the conservative way we talked about with this, which would be using about 5 to 15% leverage, only buying on dips, using the yield to get tax benefits, different things like that. Again, check the post out. It really goes into it. It's a smart way of margin investing. If you guys want to do that, just be careful. But I personally will probably going to move away from this, even though I did start it. I'm probably going to close this account, and maybe what we're going to do is focus on maxing out the TFSAs first, because we do have some TFSA contribution room, and then once we get our accounts maxed out, maybe we'll open up a non-registered and then use a small percentage of the non-registered account with margin and outline the strategy that I talked about on Blossom. So that's something we might do, because honestly, I think it would be a shame to lose and risk the TFSA, which is such an important account. I'd be much more happier to put like 10 grand or something into a non-registered margin account, have everything else separate that's kind of protected, and then worst case scenario, if that account goes, it's like, okay, whatever, it's not the end of the world, right? But to risk so much just for a little bit of a gain, especially such an important account like the TFSA, which is going to be life changing over the long run, over your lifetime, especially if you max out that TFSA and put it into some stocks and you just don't touch it and let it sit, it's going to be life changing for you. So like, I think that would be a shame to lose that. So I just wanted to point it out. I want you guys to think about this if you're going to do it, and try to do it in a smart way. I'm not saying you guys shouldn't do this. I think it's definitely a good strategy. And if you're just starting out, maybe it's the risk we're taking, but just understand the consequences of it. And we've kind of thought about it, and I think we're going to move away from that strategy that I talked about, and we're probably going to close this account, focus on the rest of our rooms, and then starting next year, fill them back up. And then if we have room for a non-registered account, we can maybe play with the account and have some fun. Or maybe what I'll even do is I'll close this account, open a non-registered margin account, and then we'll just use some small sums of money and just have some fun with it and kind of build an account up from scratch. And if you guys want me to do that, we could do that, and we could follow the same conservative. We could probably like bump it up to be a little bit less conservative, because it'll be a small amount of money and we can take on the risk, and it'd be way more easier to kind of like, if we ever have to put cash into a account you're going from the start with margin, it'd be way easier to do that. It'd be simple, and everything else is protected and cool. So I think that might be the better way of doing it. So let me know what you guys think. Check out the posts. I'll link to it in the description of this video. You guys can research it for yourself. And I think that would be a cool way of doing things. So bit of a long talk about there, but I think it's important to talk about, especially since there's going to be a lot of people playing with margin. Just be careful and understand it and set up a good way of doing this. And I think that's the best way to do it. So let's jump inside the portfolio. Let's go to passive, and I'll talk about more about our stocks and our investments there. Okay, so here's our passive account. This is going to be all of our accounts that we have basically in one place, showing you guys the total holdings, our total contributions, our total dividends, all that fun, exciting stuff here. So like I talked about earlier, this has been a pretty big year for contributions for us for a couple of different reasons. Me and my fiance, this is our first year basically of working full-time jobs. We each are making more money than we ever made. We don't make a ton of money, but with us both working full-time combined together, it's basically doubled our income. And also, since we're so frugal, it really makes a big difference, because we set up our finances and to be frugal and to save money first, and learned how to live with that. Once the money started to kind of basically come in a little bit more, and we grew and basically increased our income and different things like that, it just really benefited from that. And I recommend you guys do the same thing. Learn how to save and budget first, and then focus on growing your income, and it's gonna you're really gonna benefit from that. And yeah, lots of contributions this year. We've just been kind of throwing some money out there. We also have a little bit of money saved up. So you see, we have some pretty big contributions here. My fiance has a little bit of cash saved up, so she's been kind of dollar cost averaging that a little bit into her TFSA throughout the year, and we're hoping to kind of get that TFSA max with me and her working, contributing together. We're hoping to get that maxed by the end of the year. That'd be such a big goal for us. We'd be super happy if we had both TFSAs maxed, and then next year we can do the same thing. But we have about $20,000 or so left to put into hers. So that's going to be the focus for this year. So we're just hammering away. And that's another reason why we want to focus on budgeting again. Get back into budgeting, get back into following, get back into really trying to force ourselves to do it, so that every single dollar we have can go back into those things. So that's going to be the focus for this year, but lots of contributions. Some of these contributions aren't accurate, because this is moving like the $21,000 here in December. This is moving accounts from my account to her account, etc., etc. So some of these numbers are inflated, but the more accurate number is going to be 3,000, 1,500, 4,000, 3,000. This was a big month. We put a big chunk of money into our accounts. This was a lot of cash we have saved up, and then July and August as well. It's just been pretty big months, and hopefully going towards the end of the year, unless some major expenses come up, going to be more or less the same. We're just working at it to try and save up as much as possible. Total, we have about $303,000, so we hit the $300,000 mark in the portfolio. This is the first time ever, so this is a all-time high, new gain on the portfolio. We're going to celebrate. We're going to do like a nice dinner or something out. We're going to go out, have some fun, reward ourselves for saving. I encourage you guys to do the same. Make sure you have fun. Make sure you guys do things. But just be smart about it. But this is such a big goal for us, and it's actually crazy to think we got here as quickly as we did. A lot of that's help from the market. The markets have been doing really well, but a lot of that is also just saving, putting money in, and then not touching it. Doing it in a smart way. And that's been the theme of this channel, is to keep things simple, keep things basic, be smart, but also work hard at it too, and have a balance at the end of the day. So that's $300,000, big gain from us. We're super happy. Again, here's my accounts. Going down here, we'll cover the other accounts. So again, my partner has about $830,000 in her TFSA. Maybe we could get that to 100 grand by the end of the year and have about $300,000 in TFSAs. Maybe that might be the dream, but we'll see. Regardless, we're super happy and we're super excited about that. First home savings account for her is $8,000, so we can top that up at the end of the year. And going down here, we do have the margin account, but like I said, I'm probably going to be closing that margin account. And maybe, again, if you guys want, we'll open up a little test one and have some fun with that. That way we can take on some risk. We can apply that strategy that we talked about, and the risk is very little. It's more for fun and kind of stuff and whatnot. So let me know what you guys think about that, and we'll definitely consider doing that. And I think that's a smarter way. Going over year to date, we can check out some things here. So again, we have our contributions. We can see the value here. We're going to cover the rate of return. So Passive is saying, rough estimate, we're getting about a 10% return this year so far, and that's going to be a mixture of Canadian and US stocks with a little bit of passive income. Again, my portfolio is on Blossom if you guys want to check that out. Our whole entire portfolio is more roughly about the same. So we kind of have the same allocations, give or take, just some accounts are focused more on growth, some are focused on income. Investment growth, about $27,000 year to date across all of our accounts, mostly tax-free. And our average dividend is about $800 per month. And here's basically the months since the beginning of the year. In January, our big month, we hit $885. We had a couple of small months, and then April we hit $1,000, and then in July we hit $1,161, and then this month so far we're at about $800. So yeah, more or less there. And then I think June, July, August, September, October is going to be another big dividend month. So maybe we'll hit like $1,200 or so. We'll kind of have to see how things go. But again, the portfolio is a hybrid portfolio, focused about 60% on growth, 25% on dividend and growth, and then about 20%, if my math is correctly, something like that, on passive income. That's going to be the plan. That's kind of what we're focused on, and that's been a great balanced approach for us. So that's our portfolio here. Let's talk about our finances and stuff like that, and our budgets. We're going to cover that, and then I'll give you guys a bird's eye view how each of our individual stocks have performed as well. Alright guys, so here's our living off our dividend spreadsheet. This is kind of a budget sheet, and I haven't updated this, and I'll be honest guys, I haven't really been focusing too much on our budgets lately. One thing you can do once you get better at budgeting, and you've been doing this for a long time, is you don't have to be as hardcore with it. I'm like everybody else, and one of the biggest reasons why I follow basic principle approaches is because I'm a lazy person. Like, I just get lazy with things. I have other things I want to do. I don't want to, focus too much on things. I want to kind of just ballpark it sometimes. But it is important to revisit your budgets, kind of review your expenses, because it's very easy for things to kind of like sway in one direction, and then you get a little bit off course and you need to kind of course correct. So that happens to everybody, happens to us. We overspend sometimes, but we try to keep it. Once you get you've done it for a while, you can kind of like get it close more or less. But it is important to review it because things can creep up, especially with inflation, things like groceries and basically everything costing a lot of money nowadays. It's very easy to, accidentally go over things. So here's the sheet here. So our monthly income is roughly about $6,000. This is going to be our take home, give or take. This is from work. This is our jobs. Combined together, we make about close to $90,000 a year before taxes and stuff like that. I haven't calculated after tax income with a lot of our tax benefits like the TFSAs, contributing into the first home savings accounts, the RSPs, and other tax benefits. It's a little bit higher than that. Maybe next year or at some point in time I'll do a video to talk about our actual take home taxes and what that is close to a regular income. because there is so much you can do for tax benefits that kind of, it's not going to be life changing, but it squeezes out a little bit of extra income, and that's something that we've really optimized this year, which I wish I would have done in the past. So maybe come next year, come tax season, we'll do that. But total year-to-date dividends is $6,000, so we made about $6,000 year-to-date. Our 3-month average, like we showed you, is about it's a little bit higher than the yearly average because the dividends grow right over time. Your new deposits, dividends reinvested, kind of grow your income throughout the year. So a 3-month average had bumped up from the $800 to close to $900. And here's our monthly costs and expenses. I think everything here, I'll have to double check. This isn't why it's important to review, is because there's going to be other things. Like this is just a rough estimate of our basic expenses here. So we have things that we pay for, like movies, our coffee and tea budget, our grocery budget. These are the red numbers are going to be kind of like our max upper limit, and then the green numbers is going to be what our dividends could theoretically pay for. So, over time, as we choose to live off our dividends, or if we use dividends as a buffer or anything like that, or if we just want to see the value of what our investments are giving us later in life, we could say like, okay, you know what, if we decide to cut back on work, or if we want to kind of like if we feel like our investments are doing much for us, we can be like, okay, well, you know what, $800 a month might not seem like much, but hey, you know what, that's paying for our groceries, or it's paying for some of our expenses, or it pays for your insurance, or it pays for whatever it is you want, or for you to go out to the movies or go out to eat somewhere, or it pays for like your coffee for a month, or whatever it is, like whatever you guys want to do. You can help to kind of like encourage you to save and to do things, and kind of see how your life is actually improving and things are getting easier, because it's very easy as things grow, as you compare yourself to others who are higher up, and it just keeps going and going, it never stops. You can kind of lose sight of where you come from and how much benefit you're getting from these things over time. So this is why we do this, to see that, hey, there was a time where, we made nothing. We made like $50 a month. That was it. And, like now we could pay for our groceries if we wanted to. So like just to kind of, keep that inspiration, motivation going. But here's the different things here. Again, red numbers are going to be the total. So like our groceries are $500. Green ones are going to be what our dividends could be paying for. And this is what we're going to budget. So I'm going to really start, I think next month, we're going to really start to make a budget and really try to push this. Like if our budget is $500 a month for grocery, we're going to try and push this to get this to be within reason. We're not going to be like crazy. We're not going to sacrifice our health and well-being here. But if we could like buy stuff on sale and get some deals, and maybe we could cut that to like $300, let's try it out. Why not? Have some fun with it. But again, we're not going to make sacrifices. We're sacrificing our health. I'm not going to eat like ramen noodles for a whole month just to save $100 on groceries, or $50, whatever it is, right? There is a balanced approach here to take with this kind of stuff. We have our CDs, we have Netflix, our insurance for the car and the house. We rent an apartment, so our insurance for the house apartment is not very much. But things like that are, our dividends could pay for some of that stuff. Our rent, we have cheap rent. We lived in the same place for many, many years, a small apartment. We're going to be staying here probably for at least another year or two to save up money for a house. That's going to be the plan if that happens, or to save up money to allow our investments to grow, and then take that money to maybe rent a house for a couple years and then buy a house. We'll see. Gonna maybe do, if you guys want a video on some of this stuff, to talk about some of this stuff, maybe we'll do a video and talk about that. But this is things that I'm kind of working on right now. Gas for the car is roughly about $50 to $100 a month, so that's there. The pet expenses, since we got the cat, I talked about the kitten here. I don't know, you guys can't see her, but she's chilling just on the side on her bed there. That's going to be about extra $100, and there is vet bills too. We've had to take her to the vet. Vet bills are not cheap, but I wouldn't count that as a monthly expense, because you don't take them every single month. It's more like a buffer expense here, and I added this recreational as buffer event expense thing, which is an extra $500. So this is kind of like, got to take the cat to the vet, get her shots or something like that. That's about $100. I think it was like $100 something bucks. So stuff like that, or if you got to do certain things, or certain things pop up and you got to buy things, something breaks in the house, things like that kind of stuff here. Our internet is roughly about 100. It might be a little bit more than this, because they just keep increasing it over time. We might shop around for cheaper internet. We've had the same internet forever, so whatever. Phone bills, right? We both have some pretty cheap phone bills. We don't use our phones that much, to be honest. $70 a month. Restaurant budget is maybe, this is on the high side. We probably don't spend $200 a month, but maybe we do some months. So, that's just in case kind of thing. And the $50 is like, okay, maybe our dividends could pay us to go out for lunch or breakfast somewhere. I mean, $50 is not going to buy you a fancy place, but maybe you go for breakfast, or maybe you could go for coffees. Go to a nice coffee place for a couple days, once a week or something. I don't know. Whatever you guys want to do. Again, here's the buffer recreational budget. Adobe, I use Adobe Premiere to edit these videos. So that's on there. I like to watch UFC, so $10 a month instead of paying for pay-per-views. I watch it on there, although they have announced that they will be running them on Paramount for a cheap monthly price. So we might switch to that. But again, a lot of, doing things in a smart way to save money, this is how we do it. Wealthica, that's a tool I use for managing my investments, and then bank service charge fees. So there's going to be other stuff on here that's not included, but this is just a rough estimate of some of the basic things. And then we have our total expenses here, which is about $3,000 or so. And then this is how much we're using our dividends to spend. So we could pop up our dividends. Obviously we have some free cash. We could add some more money for groceries, theoretically, cover our insurance and all these different things. And the goal is to basically get our income to cover all of our expenses and just have a bigger buffer. So like, again, if we want to take time off work for whatever reason, if you want to work less, if you want to work different jobs that pay less, that we enjoy more, if you want to spend more money, all these different things you might want to do, we have that buffer there just in case. And again, I find this is a very highly motivating tool to see the value of your work, because you can look back and be like, hey, you know what? This hard work we did is now giving us all these different things, and it lets you appreciate things. So this is why we do this. I know I haven't talked about this for a lot since a couple of videos, but I think it'd be helpful to get back into the frugality and budgeting and these updates that I do. Anyways, guys, let's jump into the last part of the video where we'll talk about the growth of our individual stocks, and I'll give you guys an update on basically some of the holdings that we have. All right, guys, so here's the investments. Here's the total return of all of our individual stocks within all of our accounts, basically just balanced out. So here's what you guys need to do, pay attention to, is going to be the stocks up here. I'll scroll down a little bit so you guys can see better because my webcam might be blocking that. So this bottom part here with the Wealthsimple trade, this is just an old invest account that I have, so you can ignore these ETFs and stuff like that. You can get rid of them. They don't matter. It's just the accounts up here is going to be the ETF. So as you guys can see, we really streamlined our portfolio. We really condensed things to have a much more simpler approach. And this is averaged across, like I said, all of our accounts. So my accounts, my partner's accounts, everything we've ever had kind of thing. So VFE is our biggest holding. This is our growth fund. It's 60%, roughly give or take, representation of our portfolio, up about 44% all time. Very much a growth fund, all growth, and very little dividends. In fact, the dividends have only added, our growth from this account has been 40%, and the dividends have added about 4%. So not much growth from VFE, but that's not the purpose of it. The purpose of it is long-term growth. And the US markets have grown extremely well over the past 5, 6, even 10 years. So that's added tons of growth inside our portfolio. That represents about $50,000 all time. But again, that's our biggest holding, so it makes sense that it's going to have the biggest growth. VDY is going to be our Canadian Dividend Growth Fund. This is our exposure to your traditional Canadian stocks. This would be like TD Bank, all the bank stocks, the utilities, some of the financial companies, all those different ones. Up about 43%, so on par with VFE more or less. Again, much more focused on dividends, 30% growth from stock appreciation. So VDY does have stock growth. This is why I hate when people make the argument like, oh, are you growth or are you dividend based? You know what? Most stocks have a combination of the two. Some are going to be, on the spectrum of more one way or the other. And even portfolios don't have to be one way or the other. You don't have to have a growth portfolio. You don't have to have a dividend portfolio. You don't have to have a income portfolio. You can have a mixture of everything you want and kind of balance it out and cover all of life scenarios if you want. That's basically what we're doing. We're optimizing long-term growth with American markets. We're optimizing the fact that we're younger, so that growth is going to benefit us. And if it's in tax advantage accounts like TFSAs and stuff like that, we can really grow those TFSAs as quickly as possible to get that compounding growing. We're maximizing dividends because we like the psychological aspect of dividends. Canadian dividends are very tax efficient, and you also get some growth, and it helps add you some exposure to different markets. And then we're optimizing passive income to get some more dividends. And again, psychological benefits, cash buffers, and the income allows you to enjoy some of the money in the short term and the long term. You know what? There's no point investing and then dying with a bunch of money. We kind of have seen that, especially as things increase in price, like things like houses increase, monthly expenses increase. It's much more easier to use some of that income now. Yes, you lose some long-term gain, but if the long-term gain doesn't matter because you're going to have more money than you need, and you've done this and you've calculated it, and you kind of, especially with us being more aggressive, that little bit of risk, if you want to call it that, it's fine. We're okay with that. And you can see the portfolio. We've done the math. We mapped this out. The portfolio continues to grow at a pretty good rate, considering what we're doing here, right? And the dividends, it all adds up together because you get dividends from the growth funds, you get dividends from the dividend stocks, you get dividends from the passive income stocks. So it all contributes together. And again, you can fund the growth with the dividend stocks as well. Like if we don't use the income this month, we can put that back into growth stocks. They all work together to get this cool machine, this flexible kind of cash machine that gives you a lifestyle, a flexible lifestyle. Because that's really what you're doing with this, is you're buying into a lifestyle that allows you to do whatever it is you want to do. That's the goal here. So VDY, much more dividend focused, growth focused. A lot of gain coming from dividends as well, but not super crazy. It's actually pretty balanced. So mostly coming from growth when you look at it. Going down here, we have more of our covered call funds. HYLD up 40% in the portfolio. Haven't bought this for a while. We bought a lot when it dipped there during the market dips, which is why I recommend you guys buy dips. And even the covered call ones and some of the income funds, they actually benefit quite a bit from buying the dips. So what we do is we kind of focus on that. When things dip quite a bit, these funds are great because you buy them on lower yields, so you get higher yield on cost. When they rebound, you get some capital appreciation that helps protect you from if they do dip a little bit, or if you do lose some capital appreciation, you get a bit of a buffer. But look at the income, 30% of income coming from dividends. So that one's been super cool. We have HDIV, or the Canadian version of HYLD, a little bit more conservative, a little bit more balanced. 23% growth all time. We haven't been buying this one as much, but again, lots of income coming from dividends. We have FTN, which is our split share fund. In regards to the split share funds, I might swap this out. Harvest is coming out with a new high yield income based Canadian fund. We might be switching that, but you know what? FTN's been doing good for us, so we'll see how things go. But we might we might maybe split some of the holdings with that high income fund, but we'll see how things go. Again, I'm kind of experimenting with the high yields like HHIS and stuff, so we'll see how that goes. But I more or less see them, you know, the role that they fit inside our portfolio doing well. And then we have CNR, eventually going to sell this when it recovers, because I just don't want to hold any single stocks. But the railroads are down quite a bit, so we'll wait and see. It's about $4,000, so give or take, it'd be like minus $400, whatever. It's not that big of a deal. If we could sell that, get that out of the way, and put it into some of our other stocks that are going to grow better, we could always do that. But again, you could hold it and it'd probably rebound and do well. You know, it's such a good company, right? It's a staple. It's like the banks. It's going to do well over time. So you're just going to have to wait for that if that's what you guys want. But we might just sell it and just get out of the way to just get things back to where we want it to be. And then HHIS, our high yield dividend fund, about 10% already. A lot of this coming from yield. But we did buy it during the dip. Things dipped a little bit. We bought some of it, but we're going to continue buying it regardless. But again, you buy it during the dips, those yields, you get the higher yields, you get the higher yield on cost. But we're still feeling this one out. We're still not too sure about this. And then HHIC, I can't remember if that's the ticker for the Canadian one. You guys are going to have to look it up. I can't remember, but that's one we're going to be looking at as well. But we'll give it some time to kind of, you know, for things to go and do their thing. But yeah, that's pretty much it for the portfolio and for the video, guys. So if you guys have any questions, let me know. Again, check out the post I did on Blossom, if you guys, because I'd love to hear you guys' input on that. And let me know if you think it's a good move to create the margin account separate. I think it is. I think it's the right way to do it, and we can still have some fun with the margin account, but just kind of protect ourselves. So anyways, guys, let me know what you guys think. Hope you guys enjoyed the video. Take care. Have yourself a good one, and talk to you later.